So November is Financial Literacy Month in Canada, and we're happy to support its 10th year anniversary this year and to share with you today information that we hope you will find interesting and helpful in any way. So my name is Frida Richer. I'm a licensed insolvency trustee with Grant Thornton. We are a national accounting and advisory services firm providing audit, tax, and advisory services, which includes my business unit dedicated to consumer insolvency. I've been in the industry for about 25 years, helping consumers, helping Albertans resolve their financial difficulties and get back on the path of good financial wellness. I'm also a proponent of financial literacy as a key life tool in making better financial decisions. And if you tune into Global Morning News, you can watch me every last Monday of every month talking about various money matters. I'm pleased to introduce our guest, our mortgage expert, Ayesha Kothawala, who is with Gencor Mortgage Corporation, and she is based in Calgary. Ayesha is passionate about helping people achieve their financial goals, and after spending 15 years in the financial planning industry, she decided to focus on mortgages, and for the last 9 years, she's been walking her first-time home buyers through the process of purchasing their first home, but also helps Albertans throughout, the year in finding the most suitable mortgage solution. So welcome, Ayesha, and thank you for lending your expertise today in this webinar. So let's just a brief on the landscape of Alberta, the state of debt under the pandemic, pre-pandemic. So we know that, Alberta, prior to the pandemic, was heading into a slow recovery from the last recession. We were also experiencing, a dramatic drop in oil prices right before the March lockdown. And together with many households still carrying the highest levels of household consumer debt amongst the provinces, well, let's just say, it was a perfect storm of financial turmoil when the pandemic hit. And as an insolvency trustee, I've heard so many stories of Albertans struggling to keep up with their financial commitments or debt payments because they've been hit with job loss or just a greatly reduced income to their households. And a huge worry to a lot of these folks was whether they could afford to keep their homes. And I have to admit, this is one of the tougher discussions I have as a trustee because, firstly, there's that emotional tie or attachment to your home. And for many, it's their biggest investment. And the relief that arrived in March with the announcement of mortgage deferral programs that gave people the ability to defer or postpone their mortgage payments for 6 months, again, that provided a bit of that emergency relief. So Ayesha, as a mortgage advisor, tell us what you've been seeing.
What I've been seeing is, as we all have heard, the big news in the summer was this deferral cliff that the media was speaking about. This came about because initially a large number of mortgages went into deferral, but the numbers, which peaked in June, dropped off dramatically in August and September. Alberta, of course, had the highest rate of deferral. But again, like you had said earlier, the Alberta economy was struggling prior to COVID hitting because of our oil and gas industry. So initially, many people panicked and just took the deferral. Each lender, each bank and lender, they treated deferrals differently. Some did a blanket 6-month deferral right off the bat. Some did 3 months initially, and you had to reapply again after 3 months. And some initially went month to month. So what happened was a lot of people went ahead and deferred their mortgages. But when it came to renewing them, the deferrals, they did not, because they found like things settled down, they figured out where they sat. So that's why we saw such a dramatic drop. Now we'll see what happens when the deferrals are completely stopped now.
So Ayesha, some people deferred their mortgages when they really didn't need to, from the sounds of it. Did it as a precautionary measure. Perhaps they did it to free up, cash to put towards other other expenditures. And I suspect that if you're a person who doesn't earn a steady paycheck, like if you were self-employed and didn't have that steady flow of income to the household, this brought forward an opportunity to defer your mortgage payment, which would be fairly attractive to help ease up on that cash flow concern.
Yes, you're right, Frida. Many banked the saved payments. So they deferred payments. Instead of making those payments, they banked it just in case. Some actually did pay off the higher interest debt. As you said before, a lot of Albertans were carrying a lot of debt. So they used that money to pay down their debts. Also, I've spoken to some clients and they use the money to do some home rentals. So everybody used that money in different ways. Many investors who have rental properties deferred their payments because they didn't know if their tenants were going to pay. So those are different views as to how they can benefit from the deferrals. Another thing to note is arrears rates. They have remained fairly flat. Of course, people could defer their payments instead of going into arrears. As at the end of May, arrears rates in Canada were about 0.25%. And in Alberta, of course, it's a little higher at 0.5%. But really, to put it into perspective, in 2009, during the financial meltdown, in the US, 20% of mortgages went into arrears. So we're nowhere close to that. That's just to put things a little bit into perspective.
Right. And well, thanks for sharing those numbers, because again, we were far from, if we're comparing ourselves to 20%, we're definitely far from that that the US had experienced. Now, in terms of mortgage arrears, which right now, as you say, might remain still low, could it be because people are, finding ways to ensure that their mortgage payments are paid? For example, maybe tapping into their low interest lines of credit or their home equity line of credit to keep the payments continuing, even though their income hasn't quite caught up to their needs. And so I just want to get your thoughts on that. And also, what do you predict will happen with the mortgage arrears rate?
Well, I imagine there's a lot of people who are tapping into their lines of credit and home equity lines of credit and savings to make those mortgage payments. And when that runs out, I do see that we're going to have a little bit of an uptick in arrears. But we're not seeing it now, that whole deferral cliff they were talking about. But what the experts are saying is we won't see the full effects of it likely until the end of the year or into the spring next year. When we talk about mortgages, another thing that comes up are rates. Bank of Canada is not expected to raise the rates in the near term. They're saying they're going to stay low right into 2022, 2023, but that affects the bank's prime lending rates, and that in turn affects the variable rate mortgages, which are based on prime. Fixed rate mortgages, on the other hand, are based on the Bank of Canada benchmark 5-year bond yields. And those we've seen increase slightly, ever so slightly over the last while. So we've been expecting rates possibly to increase a little bit. Of course, the rates have been incredibly low, historically low. We've never had them this low. So we can't really expect to continue with that. So if you have a variable rate mortgage, I recommend you consult with your mortgage advisor to find out whether or not it's worthwhile for you to lock in.
And what would you recommend in our current climate, current environment, Ayesha, just with respect, if you are renewing your mortgage, do you recommend that people stick to sort of that fixed rate or lock it in, or stick to the variable rates?
It all depends on what variable rate we can get, but the fixed rates really are so low. Like historically, people say a variable rate, you end up further ahead in the long run. But some of the discounts, and so variable rates are based on prime and it's discounted. And some of the discounts are very small. And the fixed rate mortgages, if you can get 1.79% 2%, why not lock it in? You're guaranteed that for 5 years. So it's all on the matter of what you can stomach, because with variable rate mortgages, generally when the rates start to rise, your payments will rise as well.
Right, and I suspect that will also depend on, you know, your eligibility in terms of your credit rating and your credit score on what rate you land at. Okay.
Yes.
And so, Ayasha, what can people do if they are struggling with their mortgage payments?
So there's a few things, but a couple of important things to note here is don't wait too long. Don't wait until you're missing payments on other debts where your credit is going down. You want to consult with somebody right away and make a plan. One other thing I can't stress enough is always make your mortgage payments. It doesn't matter if you have to rob from Peter to pay Paul, you need to make those mortgage payments somehow. If you have to borrow to make them, because if you don't make your mortgage payments, it will really affect what your options are later. And it'll also affect whether or not you can get a mortgage later. I can't stress enough about that.
Hugely important, given the impact if you stop making them. Okay.
Exactly.
Yeah, good,
It
really
follows you.
Right.
So some of the things that you can look at is to review your budget. See what cuts you can make. See if that will be helpful. Will that solve your problem? Especially if you're earning a little bit less than what you were before. A lot of companies have cut pays or if you're working a 4-day work week instead of a 5-day work week. So reviewing your budget is something that you should consider.
I'm so glad you mentioned, you know, the B word, as they say, the budget, because, you know, it seems like you would go to that first thing, but it isn't always easy to get there for a lot of folks, especially with so much going on. But it really is key to ensuring, you know, you have enough money to take care of your expenditures. And I always say, look at, you know, what's the low-hanging fruit in your expenses? What can you cut out easily that you absolutely do not need to have? You know, whether it's, you know, reducing your drive-throughs, the you know, coffee, making your own coffee in the morning and sacrificing, you know, the morning drive-throughs. But there are definitely areas you can really focus on to try to reduce your expenses and increase the available cash. I'm so glad you brought that up. The budget's always important in any plan of savings.
Yes, Frida, that's right. It always is important. So something else you can do is to check to see if you can pull equity out. So you consult with your mortgage advisor and see if there's any options available to you there. Especially, that's mostly if you're still working. Even if your bank says no, still consult with a mortgage broker. There might be some other options for you. So there's A lenders, what we call A lenders, and they're the banks, the credit unions, and also some of the non-bank lenders who lend just through the broker channels. Then we have the B lenders, like they're in the alternative world. So they cater a lot these days to self-employed people and also people with bruised credit, okay? But they have a little bit wider, more options as far as debt servicing ratios go, even though they are still stress tests. Then we also have private lenders. So they're a little bit more expensive. They're a short-term solution, but if you're not currently working, but you're expecting to be working down the road, it might be a great stopgap, okay? So always consult with a mortgage broker on these. B lenders and the private mortgages involve higher interest rates, and they do involve fees, but some of those rates start from 3 to 4%. So it's always good to be able to have what all of your options are and see what will work for you. Frequently, we can leave your current mortgage intact, so you continue with the lower rate, and then we throw in a second mortgage in behind. Sometimes it could be just a HELOC if you can qualify. That's a home equity line of credit. But what do you do if you don't have any equity to pull out? That's where you consult with your lender to see if there's any options available. There are programs, but everything's on a case-by-case basis. So they look at your specific situation. So you're going to have to provide all of your financial information to the lenders, and they will assess what they can give you, okay? It might be to continue to defer payments right now, depending on your particular situation, or they might capitalize your payments. There's also an option of lowering your payments by increasing the amortization on your loan. So the key is always communicate with your lender, and that is before you miss any payments.
Be proactive.
Yes.
Be proactive.
I always tell people that you need to address things beforehand, because then you're showing the lender that you care and it's not just an afterthought. You're not sticking your head in the sand. You want to address it and you want to figure out a solution. Okay.
Yasha, sometimes people have, and I hear from consumers, they have a fear, concern of approaching their lender. And so what I'm hearing, and I was on the receiving end, I'm hearing you say is that, lenders want to work with you. The last thing they want to do is actually foreclose.
Mm-hmm.
Can you give more comments on that?
Yes, the lenders and insurers, they're all saying that they're not interested on foreclosing on people. They will work with you to see if they can find a solution. But you also have to work with them, okay? And that is a matter of reviewing your budget and being aware of your budget when you speak with them, because that's critical. Okay, you have to show that you are willing to put in the work, right?
Right, exactly. Yeah, that the state of your financial affairs and not
Yes.
having to guess in front of them, that you have it all planned out. Really important to be prepared for sure for that conversation.
And finally, this is the one that nobody likes hearing. And I know with my clients, if I believe it's the right decision, this is something that I will tell them, is sometimes you have to make the hard decision to actually sell your house. If the prospects don't look good for you, you need to really consider selling and possibly buying something smaller or renting for a while. It's not a bad thing. If you have an insured mortgage and it looks like you're going to have a shortfall on the sale, or you won't be able to pay your mortgage in full, contact your lender or your insurer, and sometimes they might be able to help out on that side. They have programs available to minimize shortfalls, okay, and the costs. They might be able to help you out there. So again, communication is key. Talk to your lender, talk to the insurer, talk to a mortgage advisor, always, but communication. And remember,
Sorry.
Go
ahead. I was wanting to go back to your comments on, that hard decision, the last resort of actually selling, and how people can sort of manage their expectations under the current sort of pandemic environment. And what is the current state of the inventory of houses for sale, generally speaking, right now?
well, throughout the summer, it's been a busy market, but inventory has been low. So I've had clients in bidding wars for houses, but the housing price still has dropped slightly. And what I recommend to people is talk to a realtor. Sometimes we like to think our house is worth so much, but maybe in reality, your house is only worth this much in this market. And so you really need to consult with a realtor and see what you can sell it. Because if you don't price your house, my experience is if you don't price your house correctly, it'll take a long time to sell.
Exactly, and I appreciate that advice, because again, managing the expectations of how quickly your house is going to sell, especially if there's an explosion of inventory of homes in the market, and provides more options to the buyer, they may take their time But also what's important is fixing the right price and being very realistic about where your property sits in the market. And again, depending on how quick you want it to sell, you have to look at that list price and make sure you got it priced right. Absolutely.
I also tell my clients, what's it going to cost you if you have to hang on to your house for 2-3 months longer? You got to consider that.
Absolutely. Right. What's the burn rate? How big of a hole are you burning in your pocket by maintaining that home? And you could have already moved away from that home and could be renting. And so you've increased your expenses. But
Yes.
no, that's a really good details, good information on what people can do. And I think that the message is to be proactive, talk to your lenders because they will want to work with you.
Also, talk to your mortgage advisor. At Gencor, we're an Alberta-based company, and we have a lot of experience in this Alberta market. What are the options for people who are dealing with non-mortgage debt?
Right. So non-mortgage debt. So we're talking about credit cards, unsecured loans, lines of credit, maybe even tax debt, maybe even student loan debt you've had from, over 7 years ago. How you decide to manage or resolve your non-mortgage debt really boils down to me, three things or three big buckets. One is, well, look at what available cash flow or sources of income do you have right now that you could use to aggressively pay down the debts. And I'm not just talking, paying the minimum payments, under what I call the never, never plan, of just keep paying that interest off and not really making a dent in that principal. Also, part of that available cash sources of income is what assets do you have that you could easily liquidate to again put towards making a huge dent in your debt. So if you have that fifth wheel trailer that's sitting there that free and clear, why not sell it and put that towards the debt? The second thing is you need to have a willingness to put a freeze on further spending on the credit, because you can have the best laid out plan of how you're going to tackle your debt, but if you continue to use the lines of credit, it's really going to derail your plans. It's like sort of essentially digging yourself out of sand. You're never really going to get out of it because it just backfills, right? You're never really getting ahead. And the third thing, that's going to decide how you manage your debt is really the amount of debt that you have and how aggressive your creditors are. If your accounts are in severe default and your creditors are, on the verge of suing you and getting that judgment order, you might need to get what's called a stay of proceedings in place through either a consumer proposal or perhaps bankruptcy to put an end or a freeze on that creditor action. So the first thing, and we've touched on this, is restructuring your budget, okay, as a first plan to aggressively pay down that debt. And this involves adjustments of spending, adjustments to lifestyle to again free up more cash. Now, some folks like to focus on their higher interest rate debt first, tackle that, and others prefer to tackle their low balance debt. So whatever way you choose, if you're motivated by seeing small successes and quick successes of paying off that small, $1,000 balance, start with that, if that's a good motivator. The other option is, and I'm talking about more informal options that people should be considering before coming to an insolvency trustee, but we will certainly cover this off in our initial consultation. And that's looking at whether a consolidation loan, would work to pay down your debts and really just shifts your debt load from several creditors to one single creditor, one single monthly payment, hopefully at a lower rate of interest than what you were paying before. Otherwise, what would be the point of that? Now, of course, the challenges are qualifying, looking at your credit rating, your credit score, your history of credit, whether you have that steady flow of income, your employment over the last 2 to 5 years. And of course, a typical criteria or metric is that total debt servicing ratio. Banks and lenders want to make sure that, that a total debt servicing ratio is not more than 40%. But even at 40%, to me, that could be, you want to aim for much lower than that for it to be manageable. Now, if you've tried these options, consolidation, restructuring your budget, selling assets, doing what you can on your own, and you reach roadblocks, then there are what we call formal programs that fall under federal legislation called the Bankruptcy and Insolvency Act that can help resolve, the debts. And one of them, I know, well, you're familiar with both, but definitely one is the consumer proposal option. And this is a debt solution that's an alternative to bankruptcy. It's got to be filed with a licensed insolvency trustee. And think of it as a consolidation of your debt where you offer to pay back just a portion or a percentage. It could be 100%, but typically less than 100%. And it's done by way of fixed monthly payments over a maximum 5 years. We can't go over 60 months. But a key part is that we cancel or stop the interest charges. So your monthly payments are being paid at no interest, so no interest component. And that provides relief to a lot of folks. It fits within their budget. So for example, if you owe $50,000 to your unsecured creditors and you offer proposal payments of $250 a month for 60 months, so that's $15,000, that represents about 30 cents on the dollar. So what's the catch here? Why would the creditors be fine with 30 cents on the dollar? They want 100%, of course. Well, this is a creditor-driven process where creditors, they have to vote, and they will vote on whether to say yes to your offer or reject it. And the motivation is that what you're offering in the proposal is going to be higher than what they would receive if you chose the bankruptcy path. So in my example, creditors getting 30%, well, if a bankruptcy gives them 5%, well, then, there's good motivation there for the creditors to make that decision. So once the creditors accept the proposal terms and once the individual completes the payments, then essentially the creditors will agree to write off or release you from any responsibility of the remaining debt. So the proposal option is for the most part an easier pill to swallow for a lot of consumers over the bankruptcy option. And bankruptcy is intended to be the last resort, as it should be, upon exhausting all options, including the consumer proposal option I've just talked about. And what a bankruptcy is it's a legal process that works to discharge or release you from your unsecured debts, okay? Now, there are a few debts that are an exception to this in Canada that survive, meaning that you can't have them written off. Debts like student loan debt, if your period study end date fell within the last 7 years. Outstanding child or spousal support, okay, if that's owing. If there are any court-imposed fines or restitution orders, or debts arising out of fraud. So those, that handful of specific types of debts or claims that will still survive a bankruptcy, you still have to pay those. So if the objective for an individual in filing a bankruptcy is to receive the discharge, to be released from the debts, well, in exchange for that discharge, in exchange for wiping out the debts, the individual has to agree to give up or assign their assets to the trustee. And I'm not talking all assets, so you don't lose everything. There are certain assets governed under provincial legislation that are protected. So for the most part, people who go bankrupt can keep their one vehicle, they still continue to pay their mortgage, their car payments, they keep their RSPs in the province of Alberta. So these are important, bits of information to know, and that's why I always recommend that, if you've reached that point where you're struggling financially, you need to get the information, speak to an insolvency trustee about the impact of whether it's a proposal or a bankruptcy, and certainly when it comes to your, what assets are protected, what assets you keep. So again, in exchange for the debts written off, you agree to assign the assets that wouldn't be protected under provincial law to the trustee, and you also agree to complete duties and requirements, which are pretty straightforward in the bankruptcy process. Now, The downside, of course, people are aware of is the negative effect, whether it's the proposal or bankruptcy, the negative effect on one's credit rating. And it isn't something we as trustees control. That those are fixed, those are set by our two credit bureaus, Equifax and TransUnion Canada. But generally speaking, if you file bankruptcy for a first time, a notation of the fact that you filed a bankruptcy stays on your credit report for 6 years after you finish the bankruptcy. So, bankruptcy typically is 9 months, add 6 years to that. For a consumer proposal, it's slightly better at the R7, stays on for 3 years after you complete the proposal. But really, I tell people, Ayasha, the bottom line is there will be a negative effect on your credit rating. It is what it is. But the focus right now, take it in steps, is to focus on resolving, cleaning up the debt, putting something in place so that you can start to rebuild and reestablish your credit rating after the fact. Now, one other option I didn't mention, it's called the Orderly Payment of Debts Program. That isn't available in all provinces. In Alberta it is. And that is basically, again, thinking of that as a consolidation of the debt, but it's ordered by the court. So it's a court consolidation where an individual would essentially agree to pay back 100% of their debt. There is no compromising of that debt. So that 30 cents on the dollar I talked about, can't do that in the OPD. It's got to be 100% of the debt. And again, the intention is that it's got to be fixed monthly manageable and affordable payments in the budget. Okay. So, look, that's a lot of information for people. And again, I stress that it's just as, if you have issues with your mortgage, you want to look at, mortgage solutions, speak to a mortgage advisor, speak to the lender. Same situation here when it comes to other non-mortgage debt and how to handle that is get the information. Have that initial discussion with the trustee. There's no charge for that initial discussion. It's simply an information session to make sure you're fully aware of the options available. Okay. So that was our presentation, just talking to and speaking to mortgage debt as well as the options I've laid out to handle and resolve your non-mortgage debt. But one of the things I want to ask you about is, Ayasha, is a reverse mortgage. Tell us, first of all, what is a reverse mortgage and how will that help the homeowner if they're, if they're in a cash crunch?
Frida, a reverse mortgage is essentially a mortgage that you don't have to make any payments on. So what happens with the interest is it gets tacked on. Anyone over the age of 55 can apply for one of these programs, and you can get up to 55% of the market value of your house at the time. There's different options. If people are scared of reverse mortgages because they feel that they're not going to own their house anymore, it's essentially a mortgage where you're capitalizing the payments. Okay, you're capitalizing the interest actually. And so, yes, you're going to owe more as time goes on, but the whole premise is that your house is going to appreciate in value as time goes on as well. So it is a great product if you're over the age of 55, and it's a great tool. Like if you have reduced income, let's say for people who've had to retire, because of all of this, they're at that age, it is an option for them. The rates of interest are probably like an alternative lender, around 4 or 5%. And what I have had some of my clients do, because they worry about losing equity in the house, they can also make interest-only payments on their house, on the mortgage. So there's a lot of options available. It's always worth exploring.
And is it possible to look at a reverse mortgage if you already have an existing, first mortgage on that property?
As long as the reverse mortgage can pay out that first mortgage. So really, like the maximum it can, well, actually, sometimes you can get a little bit more than the 55% usually. The reverse mortgage is a viable option as long as you can pay out the first mortgage. And quite often people use it to pay off debts, to gift money to their kids, or they can also draw an income from it.
Okay, well, thanks for that information on the reverse mortgages. Can you tell us generally how stress tests work when it comes to qualifying based on your experience?
Okay, Frida, the way the stress test works is we have to calculate your debt servicing ratios with the stress test. So the interest rate you're paying, it could be, let's say, 1.79%. So what we have to use to qualify you to arrive at a hypothetical payment that we qualify you with, we have to use the greater of the interest rate you're paying, so 1.79% plus 2%, so that would be 3.79, or what the current 5-year benchmark rate is, 4.79%. So right now, we're using 4.79. So it's an inflated interest rate, it's an inflated payment that we have to qualify you on. Is that clear?
You know, exactly. No, that makes sense. Now, I'm wondering though, in terms of qualifying, how often do you require, you know, another person to be on title or to be named as a co-applicant in the mortgage? Like generally speaking, with what you're seeing in Alberta, are you seeing that individuals are qualifying on their own, or do they need that sort of added security in your eyes?
Some people, I've had quite a few co-signers or guarantors on their mortgage application. Most recently is because of a young self-employed purchaser. So when you're self-employed, you're not declaring. We always say if you have a great accountant, you're not going to qualify for a mortgage. So quite often, to keep them in a regular mortgage, if they have the opportunity to have somebody co-sign for them or guarantee the loan, it is advantageous.
And what happens, Ayasha, when, you know, certainly in today's climate, when the mortgage account is in great arrears? So if we're looking at, you know, over 3 months of outstanding mortgage payments, and people come to you and say, look, how do we resolve this? What's sort of your go-to course of action for a situation like that, where the mortgage account itself is already in arrears, but yet they haven't been served with anything, there's been no notification from the bank? What could a person do?
Well, we look at contacting the lender, number one, and seeing if they can do anything. And that's what we spoke of earlier, is let's see if they will work with you. Okay, maybe capitalize some of the payments or give you time to catch up on the payments. Maybe you were laid off for a while and you're back working, so you have more of a capacity to do so. Otherwise, if you have equity, we can pull equity out of your house. Through a second mortgage, we have different options available to us, different types of mortgages. Sometimes it means getting a private mortgage in behind your first mortgage. Again, each situation is different. It depends if they have equity or not. If they don't have equity to pull out, again, it's the options that we provided earlier. Contact your lender, see what is available.
Okay, thank you, Ayasha. And if we go, you know, one step further, you know, a scenario where, let's say, the individual has already been served, with a foreclosure notice, and they know there is no reversing that. They know that during the redemption period that's often offered, there's no way they could satisfy the arrears, and so it's inevitable that the foreclosure will happen. And for those who are sort of at that stage, and they know that based on the value of their property and relative to the amount owing to the bank, that there is negative equity, that there is going to be that potential shortfall. So I just want to sort of differentiate between the conventional mortgages in Alberta versus the high ratio mortgages and what I see as a trustee. So when we're approached with that situation, the first question I will ask is the type of mortgage it is. Was it a conventional mortgage or a high ratio mortgage? If you had put less, and it's amazing actually how many people aren't quite sure. And so the next, as to whether or not it is one of those. And so the next question then is, well, did you put, at least 20% down? If you put less than 20% down, it's a high ratio, likely CMHC or Genworth backed. And that becomes the issue. As a high ratio mortgage in Alberta, if there is anticipated to be a shortfall to the bank, then that individual has exposure for the claim that would follow by Canada Mortgage Housing Corp or the insurer. So it's that claim, however, that we can resolve. So all is not lost. You may be stuck with a judgment. They still have to go through the process of crystallizing their judgment, CMHC, but we can certainly resolve that through, for example, the consumer proposal option, or depending on the state of one's financial affairs, potentially a bankruptcy. So, those are scenarios that I'm seeing a lot of people, getting stuck with that exposure after the foreclosure has occurred. They're left with these judgments coming down from a CMHC or Genworth.
Yeah, that's good to know that it can be covered through the proposal and bankruptcy.
Yeah, there's definitely ways to resolve it. There may be tough decisions, but at least, there is information out there. There's advice that you can receive, so you know how to handle it based on your family and personal circumstances. So again, I think, one of the messages that we want to convey through this presentation, Ayesha, is that there are advisors who can help you. And in some cases, it's not going to cost you a lot or anything at all as far as that initial consultation. Do you charge for the initial consultation to people if they have, want to talk about their scenario as a mortgage broker or advisor?
No, I don't. I'm always available to people if they need to ask some questions. They can call me at any time. I'll provide my number. It's 403-245-3636. My extension is 2001. But you can contact me, have a discussion about where you're sitting, and I can offer possibly some solutions or what to do next.
Perfect. Well, thanks and that is your direct contact line, Ayesha. And yes. I'll repeat that again. It's 403-245-3636 and extension 2001. And of course, as I'd mentioned at the start of the presentation, you are based in Calgary, but you're more than happy to talk to anybody in the province of Alberta.
Yes.
You service the rest of the province. Perfect. And if people have questions, they want to shoot off an email to me, absolutely, as it relates to, some of the options, the courses of action I talked about. Don't hesitate to visit our Grant Thornton website at gtdebtsolutions.com, or you can email me directly at frida.richer@ca.gt.com. I'd be happy to, jump on the phone with you and have a discussion about your situation. And, sometimes that's the hardest part, is reaching out and taking that you know, that initial step. Look, there's lots of information online. You know, you can Google search, you know, whatever you'd like to get to, you know, the information you're looking for. But sometimes that that could be a problem. You know, sometimes it's too much information, and it's tough for consumers to sort of navigate through the amount of information out there. Make it easy on yourself and just pick up the phone or send an email to an advisor or an insolvency trustee to get your questions answered. Ayasha, did you have any other further questions at all for me?
No, I think you covered everything. I learned a few things.
Excellent. Well, that's good too. Well, I want to thank you for your time in having this, you know, this informal discussion with me and the audience. So thanks again for your expertise. And to everybody else, thank you very much for joining us this late afternoon. Stay well and best of luck. Take care.
Thank you, Frida.
Okay.